So now students, today's class, we will be discussing on this, the last lecture that we were discussing, primarily, we were discussing about the PGBP. We have already covered the charging section. Now, after the charging section, students, we all are aware that under the head PGBP, we have got various adjustments that needs to be considered in arriving at the profit and gains that is chargeable under this head. Now, we have seen the characteristics of the adjustments in our first class of PGBP. While we were discussing the charging section, at that particular point of time, I gave you certain characteristics of the various adjustments. And therefore, I hope that all of you students, again, I'm requesting students that uh, please join through the portal, because the notes that we are using, primarily, those notes are already provided in the portal. The module that is there anyways, it is already uploaded in the website. That is not an issue. The point is that whatever is the LVC notes, the class notes that we provide are all uploaded in the portal. So students are requested to join through the portal and get those notes for the respective class. In fact, for today also, you will find the specified or specialized notes prepared, and primarily those are the notes that you will be getting through the portal. Now, students, coming back to our discussion in this context. So the discussion, students, that we had already was about the discussion, students, that we had already was about the various deductions, students. Various deductions which were there under the head PGBP. Now, what we have done is that the deductions from, or may I say, the provisions from section 26 to section 60, we have categorized those sections in a particular logical categories. Up till now, students, what we have discussed in this context, up till now, students, as you know, what we have discussed in the various categories are the small deductions, students, we have already have captured one by one, step by step, brick by brick, students. So small deductions, students, we have captured them in this context, and there are still some small deductions which is left that we will consider. These are the general deductions, students, is what I refer. Always keep this in mind, students. Every day, 2 minutes, always keep this first master chart in mind, students. This chart in this context, the first particular chart that was there already in your portal, this notes. So the common deductions, primarily irrespective of the SSC, those are the common deduction, students, are there. We have already discussed all about the employee related provisions. We have also discussed some provision relating to disallowances also, like the cash payment, related party, excess expenditure, so on and so forth. Isn't it? Income tax paid, disallowed, all those things. So these are the common deductions, the common particular provisions which are applicable for all the SSC, whether that common provision is about deduction or the common provision is about the disallowances. Primary 43B, old section, new section 37. The deduction to be allowed in the previous year in which payment is made. There is a extension of time allowed that you can make the payment on or before the due to the filing of the return of income. That is what is covered in section 37, which was earlier 43B. But that is applicable only in respect of some specified items, like for example, employer related payment, which is bonus and commission, which is the employer contribution to the approved funds, the taxes or the duties which is to be paid to the government, leave encashment to be paid to the employees, and the interest, students, the interest that is to be paid on the loan which has been taken from the bank primarily. Now, just out of curiosity, I'm asking one question, students. In one particular case, you don't have the extension Students, now let me ask you, students, two particular. Can any one of you, just let me ask you, and how many of you remember? I do understand that you had a very tough last week of your return filing particular season. But let me ask you, there were some two special cases of deduction on payment where there was some special point that we discussed so far as the extension of payment up to the due date. Something we discussed, students. There are two special points on that section 37. Let me let me give you a hint. What about the employee related students payment? So far as the employee related payment is concerned, please tell me, so far as the employee related payment is concerned, can anyone answer this particular part? Do they have to pay the amount? Do the employer have to pay the employee contribution to those recognized fund before the due date of the fund or before the due date of filing of the ROI if they have to claim a deduction, students? If they have to claim a deduction, students. Quickly, only for the employee. Radha, you have already hit it perfectly. Yes, yes, and NCDC. In this context, as far as the employee related is concerned, students, indeed, they now, Muskan, perfect, perfect, Muskan. Kanaya, perfect. Muskan, hope that you already have got those particular PDF from the portal that we have been using it in the earlier particular class. Kanaya, perfect. As far as the employee related payment is concerned, you need to make the payment. Employee related payment is concerned, you need to make the payment, students, on or before the due date of the filing of the ROI. This is the new law. This is the new law. Is that clear to all of you, students? However, supposingly, employer contributes employee related contribution towards these fund after the due date of filing of the ROI, after the due date of filing of the ROI, then whether in that particular case, will the employer will be eligible for deduction in the subsequent tax year? Answer is no. It is now or never. That becomes the red line. That becomes what, students? It becomes a red line, students. Perfect. Perfect. Never is the answer. I hope that all of you are clear with this one. Every one of you. Apart from that, students, apart from that, what about the MSME? MSME students, is there any particular special particular point so far as the payment to medium, small and medium enterprise is concerned? So far as the payment to MSME is concerned, is there any special point if supposingly I have a payment to be made to MSME for which I want to claim a deduction? Do we have any special point? Quickly, students, this is the last point before we hit on to our particular master master particular this thing. Kanaya, students, that is as per the MSME Act. That is specified in the MSME Act, and in the MSME, students, it is 45 days or the earlier date mentioned in the agreement. It is 45 days or earlier date which is mentioned in the agreement, as the case may be. Anyway, that is the precisely the point in this particular context. MSME Act override the IT Act provision. Perfect, Muskan. Perfect, perfect. Very good. Shall we proceed, students, further? So, students, what we have discussed primarily in this context up till now, the charging section, we have discussed also the common deduction which is applicable to all the SSEs. However, some deductions are there. Today we will hit the depreciation allowance also. We'll start with depreciation somewhere. Primarily, depreciation is the most important one. Then thereafter, students, we have also discussed about the common disallowances which are applicable to all the SSC students. To all the SSC. Is that point clear to all of you, students? Perfect. Very good. Excellent. Now, students, if you all see over here, apart from this, let's have a look, students. I have given this in the category form, students. I hope that this note is there with all of you. Module page number is also been mentioned parallelly. Students, the sectorial provisions, can you see? This sectorial provision, students, are based on the theme. What was the theme of the last class that we have introduced? The theme of the last class was the deduction that was being given was not in respect of an expenditure. The deduction which was being given was not in respect of an expenditure. The deduction that was being given was in respect of the deposit. Was in respect of deposit. So far as section 48 is concerned, so far as student section 48 is concerned, the first section, the deposit that you have made is with the NABARD. The deposit that you have made is with the NABARD for tea, coffee, rubber development. That is what the deduction would be all about. That is section 48. That is the beauty of the section, primary students. So be careful. This is the deduction, not about the expenditure. This is the deduction for deposit. Tell me one thing. I asked you in the last class. I'm asking you again. Please tell me the profit and gains chargeability. The base value is the net profit as per the profit and loss account, as per the books, isn't it? The base value on which you do the further adjustment under the head PGBP is nothing but the net profit as per the books, which is prepared in terms of the commercial accounting principle. Now, when we talk about the commercial accounting principle, the profit and loss account that we prepare, in that, do we get a deduction of a deposit? Answer is no. We get the deduction of expenditure, trading items, or trading losses, or loss which is incurred in the normal course of business, but we don't get deduction of deposit. So these deduction, if the government has to give these deductions, if the government has to give, for that they have to specifically carve out, they have to specifically carve out a special section, and that is what they did under section 48, carving out a special section so that it enables the SSE to claim a deduction which otherwise is not allowed, as per the commercial accounting principle. That is what section 48 is all about. Now, how much is the deduction, students, that is available to you? The deduction that is available to you as far as section 48 is concerned is amount that you have deposited, or 40% of PGBP before the deposit that has been made. 40% of the PGBP before the deposit deduction that you get. After the deduction, students, whatever is the profit, after the deduction, whatever is the profit, then on that profit after the deduction, you will then do the split between agricultural and non-agricultural income. The ratio was already discussed in the last class, students. In that case, isn't it? That exactly the point. The next section, students, if you can recall, was in respect of the site restoration fund. And also on that, students, we have discussed in this case, 20% is a deduction that you get. Now, students, over here, the point which I discussed with all of you was this, that you will find in the default tax regime, or the alternate tax regime, as the case may be, these deductions are not available if the SSE is under the default or alternate tax regime, as the case may be. These deductions are not available, students. Is that point clear to all of you, students? Every one of you? Now, this was where we were towards the last lecture, students, that is 32E, isn't it? This is where we were in the last lecture. In fact, we have already decoded this particular section. Just one case law was left in the last class. That is what I'm going to discuss with you right now. Students, this is about the special reserve. Special reserve, again, the bank and the financial institution, they remain healthy. They remain healthy for the purpose of providing the long-term finance. That the law says that you start putting the money in a special reserve account, and the fact that you put your money in a special reserve account, we will provide you the deduction. We shall provide you the deduction. Now, here, students, the comparison that you have to do is of three items. Item number one is the amount that you have contributed to the special reserve account. That is point number one. The second particular point, students. The second particular point, students, is what? The second particular point, students, in this particular context. The second particular point, first is the amount that you have contributed to the special reserve account. The second particular point, students, is that 20% of the profit and gains derived from the eligible business. 20% of the profit and gains which is derived from the eligible business. That is point number two. And the third one, which we decoded in the last lecture. In fact, I gave you example also of the third one. Very typical, isn't it? The third one was very unique to this section only, which is 32E. And what was the third particular point, students? The third particular point, students, in this particular case was about 2 times of the paid up share capital plus the general reserve. So paid up capital plus general reserve, add this and take twice of this amount. Paid up share capital plus general reserve, add this and take 2 times of this amount. And from that you will reduce what? The special reserve account balance standing on the 1st April of the tax year. 1st April of the tax year, students. Now, in that, I have already given you, students, the example for which we have decoded. The only thing now, students, that has to be discussed, students, over here is that particular part. What was the first one, students? What is the first particular part in this context? The first one, students, in this case, so the first particular point, students, if you all know, is 20% of the profit and gains which is derived from the eligible business. Rather, it's the same thing. 20% sites used. The only thing that differs is only the percentage. 20%. That is it. Rest of it, the entire scheme is the same. You just need to know for site restoration fund to whom it is applicable and why it is given. Why it is given? I told you the logic behind it. You drill the entire earth, Mother Earth, for 20 years because it is an oil well that you extract. 20 years extraction is happening, and suddenly then 20 years lock stock barrel, you cannot leave that particular land. You just can't go away. After drilling it for 20 years, you just can't go away. You need to restore the site, and therefore the expenditure for restoration would be huge. And there, that is the reason why, students, what they say is that we give you deduction under this section, which is amount that you deposit in the site restoration fund, which will be compared with 20% of profit and gains. Okay, that is okay. Yeah, perfect. 20%. Okay. So, students, now then, coming to this particular part, because here there is a judgment of NDC, isn't it? Supposingly, students, be careful, students. Let me give you now. I think judgment PDF already you people have. I think you all have PDF as well. If not, then at least get it from the portal and I will discuss straight away this case law also with all of you. Important ones, students, 220, all the latest Supreme Court judgment, students, something you are expected, students, to know at least the important ones, the landmark ones, important ones. So latest Supreme Court judgments, obviously at Supreme Court level, generally you will find many of the judgment that goes up till that are all the important ones only. Otherwise, no one will travel up to Supreme Court if the law is already settled earlier. Now, students, just a second. Let me take this particular slide on this NDC. Think it is. Students, please have a look to case study number 2. This case study number 2 is based on this NDC judgment. Let's have a look. Let's have a look, students. Facts of the case: a statutory financial corporation is engaged in business of providing long-term finance, okay, for agriculture. So this is what is a keyword for us. Their business, students, is of what? Providing the long-term finance. Providing the long-term finance. So this is their business in this context. For agricultural and industrial development in India, and creates and maintain a special reserve under section 32E for the tax year, besides interest on its long-term loans, okay, which is their main income. From long-term loans, interest becomes their main income, isn't it? For the financial institution, interest primarily becomes the main income. And the special reserve, students, please tell me, the special reserve account that the government wants them to create, is it for long term loan or for short term loan or any other loan? It is for the long term loan, students. So the interest income primarily is here, it is for long term loans. This is the important particular words. Huh? Be careful, because the special reserve that they want to create is meant to provide long term loans. Okay. Now, right, what they said, for the tax year, students, for the tax year, the besides interest on its long-term loan, besides interest on its long-term loan, its accounts includes three further receipts. Apart from the interest on long-term loan, they have got three further income. Which is that income? Dividend on redeemable preference shares held as investment. So obviously the bank and the financial institution may be holding some investment. From that they are earning dividend. Interest on short-term bank deposits, or maybe saying they have got surplus fund. So on a short-term basis they have deposited somewhere else. They are getting interest. And the last one is the service charges. Service charges received for administrating loans under the Sugar Development Fund on the government behalf. So that's a service charges, some activity they are doing on behalf of the government, for which they are getting service charges from the government or on behalf of the government. The corporation computed 20% deduction on the aggregate profit, which is aggregate profit including the three receipts. Which are the three receipts? This dividend, interest on short-term bank deposit, and this one, that Sugar Development Fund service charges. All the three. Assessing officer restricted it to the profit derived from long-term finance business. So AO was clear, no, only 20% I am going to give you deduction, restricted only to what, students? That particular part. Which part? I hope that all of you are clear on interest on the long-term finance. Required, examine whether the dividend, short-term deposit, interest and SDF service charges, will it be allowed? So students, please understand, this is the game. This is the keyword. It's 20% deduction, students. When we talk about 20% deduction, in this case, this 20% deduction, students, is of what? 20% of, in this context, this 20% amount deposited. Thereafter, two times of the paid up share capital plus general reserve minus the amount as on the first day of the special reserve account. That is second point. What is the third point? Maximum is 20% of the profit derived from the eligible business. And what is the eligible business in this case? What is the eligible business? The eligible business is providing long-term finance. And therefore they have used the word the profit which is derived, students, the profit which is derived. And if the profit which is derived is what is eligible for deduction, be careful. Now please hear this out, all of you, please pay attention to this one, huh? Profit derived from eligible business versus profit in relation to eligible business. So if you talk about in relation to it. Relation can be either immediate or it can be distant relationship, isn't it? Don't we say our distant relative? That is what we say. So the relationship can be either immediate or the relationship can be distant, as the case may be. Okay, but when you use the word derived, it means it is a proximate relationship, an immediate relationship. That is what is the significance of the term derived. So when you say profit derived from the eligible business, means the profit which is immediately is linked with the business itself. And that is the reason why the dividend income, the service charges, or the interest on short term deposit, they are not something which is immediately linked with the business or the eligible business of providing long term finance. And that is the reason why they will not qualify for deduction. So your profit will be restricted only in respect of the interest that you receive on providing the long term finance. And that is the upper limit. So this is what, students, the things are, and I hope that all of you are clear with this one. See the logic that has been given the Supreme Court. What they have said over here in this context, students. Over here. The word derived, can you see this one? The word derived requires a direct first degree nexus with the eligible business. Just remember this one only, students. Because you have to write at the end of it. If it comes for practical also or it comes for theory also, you will have to write this. What does the word derived means? It means the direct or first degree nexus with the eligible business. I hope that all of you are clear with this one. This why this is important, students. There is a chapter on profit link deduction in chapter number 8. There are many sections in that particular chapter where the deduction is in respect of profit derived. This phrase profit derived is going to come at multiple places. So therefore you invest your time over here and then you save your time in those particular sections. There are multiple sections that are going to come in chapter number 8. At that point of time, we will not be required to put that level of effort that we are putting it right now. I hope that every one of you are clear with this one. That is it, students. Now we proceed to our next particular theme. We are done with this theme. Which theme? Deduction on on deposits. This was a theme of what, students? The deduction on deposit. Now we move, students, to our next theme. And the next theme, students, is deduction as percentage of profit. What did I say, students, to all of you? Deduction as a percentage of profit. This is a deduction, students, that now we are going to look upon. And here there are two sections under that specific, under that list of adjustments that you have to do under the head PGBP. There are two sections which talks about that the deduction that we will provide to you, the deduction that will be providing to you would be in respect of a percentage of profit. Deduction therefore is as a percentage of profit. Two sections are there. Which are those two sections? Let's begin with this one, students. Let's begin with this. Perfect. Perfect, students. Let's begin. All good. Now, students, the first one is in respect of the provision for bad and doubtful debts. The provision for bad and doubtful debts, students, in this case, students, if you see our particular entire, if you see all the notes, because see this chapter which has been there, if you see the notes that you will get from the portal, register the benefit. So today's note, this and in the depreciation part also. So over here, students, every notes primarily, the module page referencing also has been given to you. so that if students at all want to read the module primarily, they can definitely quickly jump through to the module in the relevant particular segment. They can quickly jump through to the module also. The page numbers have been mentioned at all the particular places, students. The in this note, students, we have covered also the illustrations, practical questions, case studies, everything, so that every particular provision and the concepts are crystal clear to all of you. And if you have got any doubt, students, please feel free to address it, because PGDP becomes one of the lengthiest particular area at the end of the day, the lengthiest head of income, may I say that way. If you can understand this thing through a logical conclusion, through compartmentalization, if you can comprehend it, if you can absorb it, students, through compartmentalization of the sections, and that is going to help you to the revision. Now, students, just tell me, whenever you revise PGBP, revise it in compartments. Like in some days, Kanaya, on the other day, you were saying, sir, time where we are getting very less time. So, supposingly now you have to revise Kanaya, the provision. So, I will just say that, say for example, take three sections, which is a deduction as a percentage of deduction on deposit. Revise that. Now, today we are doing herein deduction as a percentage of what? Percentage of profit or total income. Do those sections. So, every sections are independent to each other. Every adjustments are independent to each other. So everyone being independent, you ensure that if there is a less time, revise only the theme. So you will not even know when you have completed a topic if you do the revision in bits and pieces in this particular manner. Is that clear to all of you, students? Perfect. Let's begin. Now, students, in this case, the bad debts deduction, students, the first and foremost is the general principle. The general principle for deduction of bad debts under the income tax law is one thing that you need to be very clear about it. The general principle, so far as the deduction of bad debts is concerned, students, every one of you should be very clear about it. Now, students, generally, now there is, please be careful, huh? Under the income tax law, under the income tax law, you don't get deduction. I'm talking about general. Huh? Again, I'm using the word general principle. The general principle is that you don't get deduction of bad debts on the basis of the provision. You don't get deduction of bad debts on the basis of provision. You get deduction of bad debts only if you write off the debtor as bad debts in your books of accounts. You write off the debtor. You do what? You write off the debtor in your book, students. In this case, as you write off the debtor in the books, primarily written off as bad debts, as irrevocable or bad debts. So only when you write off that you are eligible for deduction. That is one of the important condition. Other condition is the first bullet point. If you see, obviously students, like for example, credit sales. So if there is a credit sales, so in that case, debtor account debit to sales. This sales would have hit your P&L account as per the commercial accounting principle. And this sales hitting your P&L account as per the commercial accounting principle, obviously this would have been part of your net profit. This would be part of your net profit. Do you all agree? Yes. And therefore, one of the condition of deduction of bad debts is that this amount should have been considered as your income in any earlier tax year. This amount which you now want to claim as deduction of bad debts should have been considered as your income in any earlier tax year, or should have been offered as an income in any earlier tax year. That is the first particular condition, logical condition. And now, primarily, you will be eligible for deduction of bad debts. But only condition is you need to write off the debtor as irrecoverable in your books of accounts. You tell me one thing now, students, over here. Are you supposed to prove that the debt has become bad in this tax year? Only then I'm going to get deduction? Please tell me, are you supposed to prove that the debt has become bad in the tax year? Only then I'm going to get the deduction? Is that the particular concept? Answer is no. By virtue of these two conditions, SSC is no longer required. SSC is no longer required to prove that the debt has become bad in the particular tax year. What he only needs to do is only to write off the debt in the books. That's it, as bad debts. So, say for example, the person whose accounts you have written off as irrecoverable or as bad debts, possibilities are there that in the subsequent year he may come and he may give you back the money. He may come and then he may give you back the money in this particular case. Now you tell me, if he comes and he gives you the money in the subsequent year, then the recovery of bad debts earlier allowed as deduction, the recovery of bad debts earlier allowed as deduction, will that be allowed to you or not? Will that be considered as income or not? Answer is yes. So see the law over here in this case, where any debt is recovered in the subsequent tax year, the amount so recovered is the amount so recovered, students, is, that's a suspense, isn't it? Is what? Is charged as income. Charge as income in which year? Which year it will be charged? In the year in which it is recovered. The tax year is important, students, as income of that year. That year means the year of recovery. Is that point clear to all of you, students? Every one of you. So this is the general principle of bad debts in this case. Now this point I am going to discuss it in the next particular part, the last paragraph. Now come to the exception. So now we know the general principle of deduction of bad debts. The general principle is actual write-off of debt in the books. Provision for bad and doubtful debts, you are not allowed as deduction under the head PGBP. Do we have then any exception to this particular rule that even without write-off, just by virtue of creating a provision, I will be eligible for deduction? And the answer is yes. And the answer is yes, students. And that is applicable only in respect of the banking company. Can you see this one, students? Only in respect of the banking company and the financial institution. So students, the banking company and the financial institutions are the one to whom the deduction is allowed on the basis of the provision, are allowed the deduction on the basis of provision. So therefore, the law provides the deduction only to these assessees, the deduction on the basis of provision. For all the other assessee, bad debts deduction is only when you actually write off the amount in the books of accounts. I hope that all of you are clear with this one, students. Every one of you. Fine, and that exactly is the point. Now, if you see over here very carefully, students, you may be aware, I think many of you would have done bank audit, or you have read something about bank audit. Students, the banks and the financial institutions are regulated by the RBI. RBI students provide for the RBI students is providing for what? They have got their own provision norms, which is known as prudential norms. RBI has their own norms of creating a provision which is known as prudential norms. Like, for example, provision on NPAs, provision on substandard asset, provision on the standard asset. So they have got some percentile that on the NPS this much should be the provision. On the substandard asset this much should be the percentile. On the standard asset this much should be the percentile. So this is how the RBI provide the guidelines, regulations. So RBI has the regulation. So just like you do depreciation as per the books which is debited, what you do in calculating the profit and gains from business and profession, you add it back and then less depreciation under section 32. In the same way, the banking company and the financial institution who has prepared the net profit as per the books whatever is a provision that they may have debited as per the RBI norms, whether it is a provision on NPA, whether it is a provision on the substandard asset, whether that provision is on the standard asset, those provision has to be added back, because they will be eligible for deduction only on the provision that they create as per the PGBP, this Income Tax Act. So whatever is the act that provides for the provision, that is the maximum amount of provision that they will be eligible for deduction. Maximum amount. Is that point clear to all of you? So what is the maximum amount of provision that can be created as per the income tax law? This is what we are going to see now. Now, just as common sense question, students, before we start reading the provision, just let me ask you a question. I hope that, and I think, and I believe that you people would be in a position to answer me this. Let me ask you the question then. Students, if the banks or the financial institution, if the banks and the financial institution are being allowed the deduction on the basis of the provision that they create, on the basis of the provision that they create, if that is how the deduction is provided, my next question to all of you therefore is ready. My next question is, do they get the deduction of bad debts? The actual bad debts. Do they get, or are they then eligible for deduction of the actual bad debts? If they are getting the deduction, if they are getting the deduction of provision for bad and doubtful debts, then the question to all of you is, do they get the deduction of the actual bad debts? Rather, that's first condition. I'll just let this thing get over, then again I'll come back to that. Kanaya, obviously, in this case, you already got deduction on the basis of provision. Then how is it that now we will allow you the deduction of bad debts? You will not be getting the deduction of bad debts now. If you got a deduction on the basis of the provision, where is the question of now giving a deduction on the basis of actual bad debts? But there is one particular case where the deduction of bad debts can be given to the SSC, and that is, students, be careful now and please pay attention. If the total provision that has been made so far and the actual bad debts, if you compare, if the total provision that you have made so far for which you have got the deduction, and then you compare with the actual bad debts, if you find that the actual bad debts has exceeded what, the total provision that you have made so far, then in respect of the excess bad debts, the excess amount will be allowed as deduction. The excess amount will be allowed as deduction. Do you all agree to this one, students? It's logical. All of you just confirm. Logical, students. No offense. All this is logical, students. Compare the total provision that you have made so far for which you have claimed the deduction and got the deduction, and then compare that provision with the actual bad debts. And whenever the actual bad debts exceed the total provision made, then only to the extent of the excess, that the deduction of bad debts will be allowed. Is that point clear to all of you, students? Perfect, students. Perfect. I hope that all of you are clear. Perfect. Radha, Kanaya, Muskan. Perfect. Let's proceed further, students. Then that's it. I have got practical questions, students, also. Don't worry. So it's not that we are only doing theories and all. We will be backing up with the practicals also. And when we do practical, students, what I do, all the small adjustments in the practical only, we will also do it. So that those small adjustments, because that is how you're going to get in the examinations also. In the first question number, total income, generally in the total income you find these small adjustments, so that way it also makes it a bit comprehensive as well. So those case studies have been prepared. interlinked with small adjustments so that it becomes comprehensive. I already told you earlier, and I'm repeating this again, that we will always do every lecture comprehensive case study so that the practice also is equally necessary as compared to the theoretical part. Coming back now, question is, sir, how much is the deduction? How much is the deduction that we get on the provision? Let's have a look, friends. Now it depends on what, friends, whether you are a scheduled bank, non-scheduled bank, cooperative bank. Now these are RBI categorization. I'm not getting into that, but cooperative bank, should just be careful over here. Right now, just cooperative bank other than primary agricultural credit society and primary agricultural and primary cooperative agricultural society. Students, just only this much. Why I'm saying right now, we will not be discussing this part extensively, but remember, students, in Inter CA, if you can recall the old section ATP deduction on cooperative society, I don't know whether that section was there or not. Be that as it may, there was a particular, if those who can recall, there was a deduction of cooperative society ATP. Similarly, that section is now replaced with another section number. And there is a chapter number 8. There is something that needs to have an interlinking with this. Right now, it will become very dry. Just for the time being, scheduled banks, non-scheduled banks, and cooperative bank. For it, how do you remember? All cooperative banks are covered except for primary agricultural and rural development banks. Primary agricultural and rural development banks, except for them, all the other cooperative banks are covered for getting deduction on the basis of provision. Okay. Now, how much provision deduction they get? Students, be careful. Huh? The deduction of provision shall not exceed the aggregate of what, students? 8.5% of the total income. 8.5% of the total income. Computed before what, students? Before making any deduction under this provision and chapter 8. What is chapter 8? Earlier it was chapter 6A. Now it is chapter 8, students. Students, just only one quick question for which I need an answer. Earlier, it was just think of old law. I know that it will take some more time as you will go to the other heads of income. These things will settle down. Don't worry in that. One by step, we will take that into account. Categorization, compartmentalization. Just for time being, recall. In fact, I have already given you certain notes in my first class also, but just recall your interest here. This is deduction of what? PGBP or total income? Or GTI? What is GTI? Can anyone tell me what is GTI? Students, what is GTI? Try, just give it a try, students. What is GTI? Definition of GTI? Five heads of income total, excluding the deductions. Okay. So you are going straight. I want to go on a reverse order. Can you define GTI on a reverse order? Can you define GTI on a reverse order? You are going rather on the straight line. It's going five heads of income. Then this thing. Kanaya, there you are. GTI students. No. Kanaya, no. That require a bit of modification. Muskan, do you want to try? Hear it. Abhijit. Okay. Abhijit, that's a decent try. Very good. Muskan, perfect. So you people have got the crux of it. Now let me in fact give a official particular definition itself. Okay. Now rather you went straight, like you went heads of income, exclude this one. I'm going in reverse order. When I say reverse order, GTI is total income. Total income is my last stage. Total income, which Abhijit, you are saying this as taxable income. Okay, actually you should use the word total income. So total income minus chapter 6A in the old law. In the new law, it will be chapter 8. Old law, it is chapter 6A. In the new law, it is chapter 8. Now you tell me one thing. This GTI, which is there. So, GTI is total income before chapter 6A in the old law, and in the new law, it is chapter 8. This GTI is after the set off of loss, or this GTI is before the set off of loss? This you should be in a position to answer. This GTI is after the set off of loss, or this GTI is before the set off of loss? What do you think of it, students? Quickly! Fastest finger first, students. That is how it should be. Abhijit. Indeed. Kanaya, Radha, in this case. So, students in this context, here in Muskan, you should hear it. The GTI, students, is after GTI, there is only chapter 6A. Chapter 6 is all 80 series. I'm just recalling your old ATC, ATD, set of provision was in 70, 71, 72. So after adjusting the 70 section, which is a set off, that you arrive at GTI. So GTI, students, is GTI is always after the set off of losses. Okay, GTI is always after set off of losses. I hope that all of you are clear with this one now. No misunderstanding on this part now. So GTI is total income minus chapter 8 deduction. Minus chapter 8 deduction with as per the new law. This GTI is arrived after adjusting all the five heads of income, clubbing of income, and after adjusting all the set off of losses, that we arrive at the GTI. And then from the GTI, we give the chapter 8 deduction. After chapter 8 deduction, we get the total income. After chapter 8 deduction, we get what? The total income. Is that crystal clear to all of you students? The entire total income computation? Fine. So, in this particular case, why I'm emphasizing? Because this section is capable of creating a trouble if you are not clear on this particular part. If you are not clear on this particular part, then this section is all capable of creating a trouble, students, to all of you. So therefore, I hope that every one of you are now clear on this part. Because just again have a look. The deduction that we are talking about in the first particular bullet point is of what? 8.5% of the total income. What is this total income? In fact, you should write, students, in your notebook this deduction for the schedule bank provision for bad and doubtful debts. 8.5% that you can see of the total income. This total income is computed before making this deduction. Before making this deduction, under this section, obviously it has to be before this section, because this section only we are trying to find out. So the total income has to be before this section, and they are also referring to and chapter 8 and chapter 8. So can I therefore say this 8.5% in a way? So 8.5% of G, in a simple word, GTI before deduction under section 31. This is 31, by the way, students. I just confirm once, huh? 31 or 32? 8.5% of GTI. I'll confirm through the act itself, students. Don't worry. Okay, just write 8.5% of GTI before this section. Okay, students. Perfect. Perfect. So you will have to compute your GTI, which means that all the brought forward losses you need to adjust. If you have got any unabsorbed depreciation, everything you will have to adjust, arrive at your GTI, and of that GTI provide 8.5%. Not only that, students, this section also provide an additional deduction of provision. Just like you have additional depreciation, students. You have an additional depreciation, isn't it? Only for a manufacturing concern. only for a manufacturing concern, not for all, only for a manufacturing concern. Similarly, here also, there is a concept of additional provision. Now, this additional provision, students, is applicable only when the bank gives rural advances. Now, just imagine this, students. There would be a lot of defaulters in the rural area. Do you all agree? There would be lot of defaulters where in the rural areas. Do you all agree? Yes. And if there would be lot of defaulters in the rural areas, what happens is that like branch is State Bank of India in the rural branch, they may have lot of defaulters. So therefore, there they should be getting extra particular provision and accordingly an additional amount. Can you see the second bullet point? Additional amount, but not exceeding 10% of the aggregate average advance made by the rural branch. Aggregate average advance made by the rural branch. So whatever rural branch may have made the advance of that, they say take average, and of that average 10% is the additional provision deduction that they get. Who gets it? Scheduled bank, non-scheduled bank, and cooperative bank. In cooperative bank, two are excluded. They are primarily agricultural cooperative society and rural development bank. They are excluded. Is that clear to all of you, students? And this is logical, no? Because there is higher defaulters in the rural area. So accordingly, they get higher amount. Now, students, in examination, they don't ask you calculate aggregate average advance. But any students who would want to know how to calculate aggregate average advance, Rule 22 of the Income Tax Rules 2026 provides the same, for which I have also given you the illustration. Just you may read it once at your own leisure, okay, just to know how to calculate this thing. But in the examination, they will provide you this information. But nevertheless, at least once, whenever you find the notes, by the way, the notes will be up by next particular session. You will find this notes already been there. I hope that all of you are clear with this one. Now, students, there are some additional particular points relating to banking business, which is also something covered in other set of provision. So what I have done is that I have just hold on, just hold on, just hold on, just hold on. Students, question is, what about IDBI, IFCI, foreign banks, HSBC? They are also providing advances. They are also providing loans. They will also have defaulters. So, do they also get the deduction on the same parameter? And the answer is yes, they also get the deduction on the basis of provision. Financial institutions, foreign banks, they also get the deduction on the basis of provision. However, the rate of creating the provision is lower. If you see, students, for the financial institution or for the foreign banks, can you see this one particular part, students, over here? For the financial institution, foreign banks, public financial institution, state banks, and all those stuff. Provision of how much? 5% only of what? Same GTI before this section, before deduction of this section. So whatever is the GTI before the deduction of this section, of that you take 5%. This is the maximum provision that will be allowed. Many students may ask, sir, what about this additional provision which you already have discussed earlier, that 10% of the aggregate average advance, whether that also would be allowed? Answer is no. Why it will not be allowed, students? You know the answer for it, students. What is the reason? What is the reason? Exactly, students. The reason is very clear. You don't find Citibank or HSBC or IDBI in village, isn't it? So therefore there is no need of creating those additional particular point. Now, students, as I told you, students, just to if you get in the examination question of total income on of a banking company, total income, compute the of income of a banking company. Okay. So not only that the question would be of provision for bad and doubtful debts, it may also be about some common provision of disallowances or deductions, as the case may be. There could be also, students, some other provision now we are going to discuss, which actually are only meant for the bank and financial institution or the case laws or the some provision, which we are going to discuss it right now. Please pay attention, students. Students, just think of these particular, just think of this. A bank is following mercantile system of an accounting to make the books of accounts. Okay. Now, supposingly a particular loan has become an NPA. If a particular loan has become an NPA, non-performing asset, just think of this particular case. Assessing officer can make an argument that, look, boss, I don't care. Your loan has become NPA, I don't care. As per the mercantile system of accounting, kindly accrue your interest income. Kindly what? Accrue your interest income in your books. And accordingly, AO, assessing officer, can harass the assessee. He may try to add those particular income, even though the loan is an NPA. So to ensure what? That there is no such dispute, primarily that arises between the assessee and the department, there is a specific provision, students, which says what? That in the case of a non-performing asset, students, in the case of a non-performing asset, the profit will be charged. Students, the profit would be charged, the interest would be charged when they are either credited to the books of accounts, when they are what? Credited to the books of accounts, or what, students? Or they are actually received, whichever is earlier. Can you see this one? Is chargeable to tax in the tax year. Which year it will be charged? Not on accrual basis, but on when it is credited. Credited where? In the books, which means in your profit and loss account. And tell me one thing, when the assessee is going to credit it? When the assessee is going to credit it, think of it. Assessee applying prudence, he will credit only when there is a reasonable certainty that now he is going to receive it. Only then he is going to credit it. Or when it is on or on the safer side, or when it is actually received, whichever is earlier. When it is actually received, whichever is earlier. So interest on the non-performing asset is considered as income in which previous year, in which tax year? The tax year is the year in which the interest is credited in the profit and loss account, or the year in which it is actually received, whichever happens earlier. I hope that all of you are students clear with this one. Every one of you. So that is one thing that you should always bear it in mind. Students, sometimes they may try to say that this NPA is known as sticky loans. Huh? These are, see, banking terms are there. This term, sticky loan or sticky interest. What do you mean by sticky interest? Which is interest on NPA. Just write in your notebook. Sticky loan means NPA. Sticky interest means interest on NPAs. Interest on NPAs. Now, students, be careful. Now, students, you may be aware of this particular part also. Many of you would be aware of this particular part. Now, students, RBI requires, you remember RBI, that they need to maintain SLR, CRR, reserves and all. That needs to be kept for ensuring that they are having their liquidity norms are very important. SLR, CRR. Have you done bank audit and all? If you do it, you will know those things. Anyways, what they do, the bank, the RBI require the bank that, look, you will have to have your funds in a liquid form, some portion in a semi-liquid form, and some portion in a long term, like bullions or so, or government securities, like that. Now, generally, when you talk about the second category, like a short term, you keep doing short term investments. Don't keep the fund idle. Put the money somewhere in the short term particular investments. So the bank does lot of short term investment on treasury bills, etc., etc. A lot of short term investment they do. Now, if they do short term investment, just think of it. For a bank, the volume of purchase and sale for the bank would be very high. The volume of purchase and sale of the bank would be very high. Therefore, and these are for short term purpose. It means I'm purchasing tomorrow. Sorry, I'm purchasing today. Tomorrow I may transfer it. These are for short term purpose. 10 days, 15 days, 7 days, like that. So therefore, these particular securities are known as held for trading purpose. These are the security held for trading purpose. Now, if a security or a stock is held for trading purpose, please tell me what is the accounting principle that you always bear it in mind? What is generally the accounting principle that you keep it in mind? If the stock or the security or the stock is held for trading purpose, how do you do the valuation? Students, how do you do the valuation of that particular stock which is held for trading purpose? See, one is for investment purpose. Investment purpose, all we know, it is for cost. It is to be to be valued at cost or historical cost basis. And anything which is for trading purpose, those particular security will be valued on what basis? Cost or NRV. Indeed, students, cost or NRV, whichever is those. Perfect. Perfect. That exactly is the point, students. Perfect. Kariya, Muskan, Radha, that exactly is the point. Cost or NRV, whichever is lower, students. Isn't it? And that exactly is the point, students. Perfect. So here, students, just keep this particular point in mind because this is what it is. So accordingly, this is what is the scenario. So this is one of the judgment also which has been there. Now we will do, students, a practical question, and after that we will come to an ICDS number 8. We'll do ICDS number 8 after we are done with that practical question which I was telling you. After that, we will do ICDS number 8, students. So even ICDS, I told you, students, we will integrate the ICDS. Students, we will integrate the ICDS. Isn't it? And that exactly is the point. Now, students, just have a look to this big question. I told you I have covered everything. Meaning thereby, I have covered all the small particular adjustments also. Everything. So, questions are comprehensive. ABC Bank Limited, an Indian scheduled bank, furnishes the following particulars for tax year 26-27. For tax year 26-27. After this, students, if you see, in this context, please have a look. For tax year 26-27, after this, all amounts are in crores. Compute the income under the head PGBP and the total income. So net profit has been given. I'm not seeing the figure. Depreciation charge in the books. What I'm going to do, I'm going to add back and I'm going to reduce only the depreciation under section 33. Earlier it was 32, it is now 33. Provision for bad and doubtful debt created and debited to the profit and loss account. So this provision is as per the books. And if it is as per the books, all we know, it has to be added back. The current year provision of 57.32 was credited to the provision account before the bad debts of 45 crores were written off. Now, so there is a bad debt which has been written off and debited to that account. So this, there at least we know there is a bad debt, students, of 45 crores. Now this 45 crores bad debts, I am going to compare with which provision? Provision as per the books or provision which I have claimed as a deduction. And what I told you, it is not about the current year provision only, the total provision made so far. So it is on a gross basis, primarily. The total versus total. Total provision that has been made so far for which you have been claimed as a deduction and the total bad debts. Primarily in that case. So the total bad debt so far is 45 crores. Now you tell me whether you will compare this 45 with the provision as per the books or provision as per the income tax law, as per the income tax law. And then you will check whether this bad debts which is there of 45 crores, whether that has exceeded the total provision or not. If it has exceeded the total provision, only then the excess bad debts would be allowed as deduction. Now, friends, after this, if you see opening credit balance in the provision account representing deduction allowed in the earlier tax year, why this information is necessary? Total provision will then be compared with the actual bad debts. bad debts written off by debiting the provision account, not the profit and loss account. I think that 45 crores is already known to us above. So that already is known to us 45. Perfect. So that any case has been written off to the provision account so that we know. But this provision account is a books provision. We don't has got any relevance of the book provision. We just need to know whether the actual bad debts of 45 is more than the total provision as per the income tax law or not. That is what is our only particular thing. Now, what about students? The provision for standard assets debited to profit and loss account. They will keep naming students anything. Huh? Provision for standard asset, provision for substandard asset, provision for NPAs. It is nothing but the provision as per the books. What I'm going to do? Add back. Depreciation as per the books. Add back. Depreciation under section 32 reduce. Same thing is to be done over here also. Aggregate average advance students made by rural branch. Made by what? Rural branch students. Now, if you see over here, this information is for what? Advance information is given to you. 10% of this is what would be added to the current year 8.5% of GTI before the deduction of this section. So 8.5% of GTI plus this 10% is the current year provision. And then you will add this current year provision with the opening provision and then compare with the bad debts also to check whether bad debts actual amount is it in excess of the total provision, and if it is, then the excess amount will be allowed as deduction. If not, then forget the bad debts deduction. You will only be getting the deduction of provision in the current year. So what is the deduction of provision in the current year? It would be 8.5% of the GTI and the 10% of the aggregate average advances. Now, students, brought forward business loss of last tax year and also UAD of the last tax year. Students, tell me now, be careful while arriving at the qualifying amount on which that 8.5% would be applied. While arriving at the qualifying amount on which that 8.5% would be applied, whether I am going to set off these two items or not. While arriving at the qualifying amount on which that 8.5% will be applied, whether these two brought forward business loss, UAD, will that be reduced or not? Answer is yes. I already told you because GTI, 8.5% is on GTI, and accordingly, in that case, this particular two items has to be adjusted in arriving at the qualifying amount on which 8.5% would be applied. Bonus to employees debited to profit and loss account and paid on or before the due date for furnishing of the ROI. Will this bonus be allowed as deduction? Yes. And if it is debited to PNL and you say that, sir, it is allowed as deduction under section 37, old section was 43B, new section is 37. So what you are going to say that this bonus will be allowed to you as deduction, and accordingly no further adjustment will be required because it is already debited. Interest payable to a specified financial entity debited to the profit and loss account and paid after the due date for furnishing of the return of income. So interest on loan which has been taken, and on that I have paid the interest amount. Now this interest amount which has been paid after the due date of filing of the ROI. First question is whether the interest on loan taken from bank, taken from financial institution, whether the interest on that loan is it covered under section 37 for the purpose of deduction in the tax year in which the payment is made? Answer is yes. Answer is yes. So this interest deduction, students, unfortunately will not be allowed to you in this tax year because you have not made the payment on or before the due date of filing of the ROI. Okay. Interest expenditure of rupees 10 crores payable to a resident depositor was debited to the profit and loss account. Tax was deducted. When the tax was deducted, TDS, students. Now, I already told you to just read this particular thing and come. Tax was deducted during the tax year, but deposited, students, when it was deposited. So during in the previous year, they have deducted the tax. When they are depositing it, deposited deposited after the due date of furnishing of ROI. Tell me then, students. You tell me, students, what is your treatment of this? Please tell me the treatment of this item then. Every one of you. Treatment of this particular item, I need to know from all of you. Quickly, students. What will happen in this case? No adjustment, or you will do some adjustment? Kanaya, Radha, Muskan. Whether 100% will be disallowed or only 30% will be disallowed. This is where the mistake can happen. Whether you say, sir, it is the TDS has been deducted, but it is not deposited before the due date of filing of the ROI. So, therefore, you question to all of you is fine, it is disallowed because you have not deposited the TDS on or before the due date of filing of the ROI. My next question is ready. In this case, 100% disallowed or 30% disallowed. So you have to check who is the payee, who is the recipient. If the recipient or the payee is a resident, in that case, students, if the recipient or the payee is resident, in that case, can you see the resident depositor? And that exactly is the point, students. That exactly is the point. I hope that all of you are clear with this one. So students, over here, if you see resident depositor, 30% disallowed. So 3 crores add back. Next question, next point, students, cash payment of 40 lakhs on a single day to a transport operator for plying a goods carriage exceeds the prescribed limit of 35,000. So by the way, this question, this adjustment could have drafted properly also, but nevertheless, idea is, students, remember that there are two limits, 10,000 and 35,000 limits for the transporter. If you make the payment to a transporter who is engaged in the plying of the goods or so, goods carriage vehicle, so the limit is higher side 35,000. So here they say 40 lakhs is paid on a single day. Obviously, it is exceeding the threshold of 35,000. You will have to add. You don't have any other choice. Net valuation of net valuation loss of 30 crores on security classified under uh, AFS. AFS means available for sale. And FVTPL, these are the terms, fair value, all that thing. So I think these are the accounting terms. Just understand, available for sale, the way held for trading purpose. So net valuation loss of 30 crores on security classified under available for sale, representing, students, representing what? Representing the amount. So this loss of 30 crores is representing what? The amount permissible under the ICDS 8 Part B primary, read with the applicable RBI direction, that we'll see. And if ICDS allows it, then it allows it. As simple as that. We don't have any other choice, isn't it? If ICDS allows it, it allows it. I told you in the first class itself of PGBP. Adjustment as per the ICDS. So they say that it is allowed as per the ICDS and the applicable RBI direction. So whether this 30 crores, now this already has been debited, students. And if it is already, because it is already classified, na? Classified that way as held for trading purpose. So if it is held for trading purpose, even in the books itself, this loss would have been recognized. If it is available for sale category in the books itself, then this loss would be recognized in the book itself. So already it would have been adjusted. No further adjustment therefore is required. What about the next one? Unrealized interest of 65 crores on prescribed non-performing assets was neither credited to the profit and loss account nor actually received. Sticky interest. This is nothing but the interest on NPA. neither credited to the profit and loss account nor actually received. What you're going to do about this interest? Ignore. You will not consider this at all, students. I hope that all of you are clear with this one. Now, students, the computation of first, this is nothing but what? So, what is this computation about? This is about the GTI, adjusted profit, for applying 8.5%. See what you do? You GTI means first you calculate your PGBP at least properly. Then you do the set off of brought forward loss, UAD. Those set off has to be done. You get your GTI. Please have a look. Then in that case, students, in this context, please have a look, students, over here. So set off, students, in this regard, 45. Sorry. Net profit is 280 as per the books. Add depreciation charge in the books. We've discussed it already. Provision for bad and doubtful debts, 50, 57 something. Also, provision for standard asset also to be added back. Add interest paid after the due date, 100% added back. Interest paid to that financial institution from whom you have taken the loan, but you have paid the interest after the due date. It is therefore to be allowed in the next year. This year disallowed. Add back. Then the TDS default, 30% would be added back. And then cash payment exceeding the prescribed limit is how much? 0.40. So that also to be added back. Now you get your profit for business. Now after doing the profit for business, less depreciation under section 33. Just a second, students. Is there a brought for loss also in this question? So this is students current year depreciation. Current year depreciation. Okay. Now, students, obviously, on now on this profit, two special deductions still left. This is a current year depreciation, 52. Now there are two special adjustment because we have to get the GTI. 8.5% is on what? GTI. So on this balance 341.72, I will be reducing UAD and I would also be reducing this brought forward business loss because I am applying 8.5%. 8.5% on what? On the indeed students. On the GTI. So the current year profit, now you will reduce it with the brought forward business loss, and then in this case the UAD, brought forward business loss, and then students the UAD. I hope that all of you are clear with this one, every one of you, and that exactly is the point. By the way, students, I hope that you all are aware brought forward business loss comes first in the hierarchy of set off. When you do this set off, the hierarchy brought forward business loss comes first and then comes the UAD. I hope that all of you are aware at least those things of the old law. Why in the old law this was there? Why it was there? Because brought forward business loss has a limited year of set off of 8 years, whereas UAD has an unlimited year of carry forward and set off. And that is the reason why in the hierarchy, students just pay attention. In the hierarchy, first you adjust current year depreciation, then you reduce the brought forward business loss, and then you reduce the unabsorbed depreciation. This is the hierarchy. This is your hierarchy. Is that clear to all of you students? All of you are clear with this one? This is what it is at the end of the day. Now you get your students GTI. All of you students, you get your what? GTI. GTI is 271.72 on that 8.5%. And then that additional, you can make a mistake by taking this 10%. Do you know what is a mistake that you can do? You can take this 10% on the, on that again GTI. No, 8.5% is on that GTI amount. But this 10% is not on the GTI. This 10% is on what? It is on the average rural advances, which is 300, and therefore the maximum provision in the current year, students, is how much? Maximum provision that you can get is 53.10. Whereas in the books, how much provision that you have taken? 57.32. 57.50. This is the maximum provision that you can get. 53.3. Maximum provision. Whereas in the books, how much provision, students, you have already have taken? 57.32. So therefore, your maximum provision deduction is 53.10. 53.10. Now my next question to all of you students. So this is the deduction that you will get in arriving at your PGBP. So this is your PGBP deduction in this case. And now students, once you get your, now here, students, just come back to your PGBP amount. What is the PGBP amount? 341. From this 341, now I'll reduce what? From this 341, I'll now reduce my 53.10. 53.10. So I will now reduce, students, in this case 53.10. Now, students, now here I'll reduce what? The question is also not only about PGBP but also of total income. So if the question is also of total income, not only about PGBP, so therefore that set off and that particular UAD all adjustment all have to be done. How much is the UAD, students? How much is the UAD in this case? How much is the brought for business loss? It is 30. And how much is the UAD deduction is 40. And finally, I will get how much, students, in this case? Finally, students, I have whatever it be, it doesn't matter. 341.72 minus, in this case, 53.10, which is the maximum provision deduction which I will be getting it, minus 30, and thereafter minus 40 in this case. So this is the actual deduction, actual total income that I'm getting it over here. Is that point clear to all of you? Tell me one thing now, whether the SSC in this case, will he be eligible for the deduction of actual bad debts? Whether the SSC in this particular case, will he be eligible for deduction of the actual bad debts? Yes. Will he be eligible? Answer is no, students. Why? Because his opening provision and the current year provision, if you add, it is much in excess of the actual bad debts. The provision deduction that he has got is much higher as compared to the actual bad debts. So therefore, there is no question of deduction of bad debts. That is given in the notes. That is given in the notes to the solution. My one question to all of you is, didn't you thought, because this query comes in the mind of the students before we proceed, the query is this, that don't you think, students, that we have taken the deduction twice? Students, don't you think that we have taken the deduction twice? Taken the deduction twice means we have taken the deduction twice, students, of brought for business loss and UAD. Don't you think that we have taken the deduction twice of brought for business loss and UAD in this entire calculation? Think over it and let me know. Take a pause, 10-15 seconds. Introspect on this question. Get me the answer. Rather, which means that in the calculation that I did in this right now, two times I took the deduction in the calculation. So over here, if you see very carefully the calculation, students, if you see the calculation, the first calculation I did was only to arrive at the qualifying amount. What is qualifying amount? GTI on that 8.5%. So to arrive at the qualifying amount on which I'm going to apply 8.5%, so as to determine my current year provision, I have reduced the two amounts. Okay, that is it. So that was only for a limited purpose, not for the purpose. That reduction was only for arriving at the qualifying amount, not for the purpose of arriving at PGBP. So that is the qualifying amount reduction that I did to arrive at my GTI, because the deduction was the percentage of GTI. Is that clear? Once I got the current year provision figure, which was 53.10, then my purpose is served. Muskan. Yes, the second time reduction that I did was to compute a total income. Once I got my figure of 53.10, Muskan, you're correct. Once I got the deduction of 53.10, I got my goal that how much of deduction would be allowed, which is 53.10. Then was my next step. What was my next step, students? Easy thing. My next step was now directly compute my total income. And now when I compute my total income, what I did, I came to the 341 figure, which was before all the set off. So on that 341 figure, first I reduced that 53.10, which was for provision for bad and doubtful debts, allowed as deduction. I reduced that. Once I reduced that, then I did the brought forth business loss of 30, UAD of 40. That was for computing the total income. That is what you said it perfectly well, students. I hope that all of you are clear with this, students now. Because see, these are the areas of silly mistakes, students. This is where students really make a silly mistake, and that is the reason why students don't make the silly mistakes in these cases. That's the reason why I was just, in fact, giving this particular thing, just putting a doubt in your mind. This was just an attempt to put a doubt in your mind and nothing else. You are very much correct, students, in the interpretation that you people have done it. So this was just an attempt to put a doubt in your mind in this context and nothing else. Now, students, a very quick reference to the ICDS 8, because there was a lot of security evaluation that we were discussing it. So therefore, let's try to very quickly run through ICDS 8, students. All of you. As a footnote, ICDS 8, this is how you have to do. We already did, students, ICDS 10, ICDS 1. ICDS 10 was for, remember, that contingent liability. When the contingent liability will be allowed to you as deduction, when you satisfy. Contingent liability means whenever a future liability satisfy two conditions, you will get the deduction. And the two conditions are the liability should be reasonably certain. Liability should be reasonably certain and it should be capable of being ascertained. This we learned in the first class of PGBP. In fact, students, I need not tell you these lectures are already there in the YouTube also. So of that, of ICAI, so you can always revise it for not only for this any subjects primary. So please revise it whenever you find some time. I told you students, please be smart enough. Record certain areas. See, you should always make a notebook. So say for example, any lectures that we are doing, lecture number 3 of PGVP or any faculty's lectures that you do, you just take a note of the timing. Like this is third class and somewhere this concept somewhere in between, after 1 hour, after 2 hours, like that, you just try to take a note of it. So right now, because these are the initial stages, this kind of thing. So if you have to revise it, that much part only, because you should be aware or you should be smart enough to know how much or what to revise primarily. That is what I was telling the last class also towards the end. Smartness is all about what? CA final is about to know how much to revise, what to revise, and when to revise. That is the game of CA final. You do this, you are not only a candidate of this thing, CA cracking the examination, but primarily a lot of things in life. So students, this is the point. So please maintain the diary so that you effectively capture those class number. And if any concept you think that this may be a bit tricky, which I just require a bit of quick revision, just immediately, like maybe an hour or so, we just write this much after that, around that. This is what's discussed. So this will go on a long way, students, for you to revise this entire syllabus. Now let's come back to ICDS 8 students quickly. And now, because after the break, I'll be catching up with depreciation part. After the break, students, I'll be catching up with depreciation part. So I just need to quickly run through this two small issues which are being there. So let me go through that first. So today, students, I will play depreciation on your territory. Okay, let's play depreciation on your territory. You'll say, sir, what do you mean by playing depreciation on your territory? Means something that you all are comfortable with. Maybe then tomorrow session, we will take across something which is a bit advanced. You may be knowing about the advanced provision also, but nevertheless, okay, I am just giving you the benefit of doubt. Now, students, this ICDS number 8, point number 6. This is an additional particular thing. Just read it, students. I want all of you, I think you can just see the slide here. See, there are two parts which is there. Part B is what students we did right now. I'll just try to finish it off part B because part A applies other than part B. You will get question on part A only. Why is it so? Because part B is specific only to the bank and the financial institution. And for them, the valuation of security, students, that will depend upon the RBI. RBI direction, whatever the direction, how to value the security, how to classify the security, what is the criteria of classification, all are being directed by the RBI. Income tax law does not get into that. Yes, income tax law has got the objection on the provision for bad and doubtful debts as per the RBI and prudential norms. That they have got the objection. They say that we don't recognize the provision for bad and doubtful debts as per the RBI prudential norm. We will not give you the deduction. We will give you deduction in our own particular manner, for which they have prescribed the percentage. But so far as what? So far as the valuation is concerned, how to value your securities, that in part B says, let us leave it to RBI to decide. And that is what? If the RBI says cost or NRV, whichever is lower, let's take that. If the RBI says cost, we'll go with that. How to classify the security, which security should be classified as for trading purpose or for sale purpose or for investment purpose, let RBI only take a call on that. Therefore, part B becomes a bit inconsequential. So therefore, then to whom part A applies? Be careful, students. Understand one thing. The securities, if you see over here, this is security which are held as stock in trade. Be careful, students here. Securities which are held as an investment. ICDS 8 not applicable. Just write one sentence. Securities held as investment. ICDS 8 part A not applicable. Part B, students, we don't care, frankly speaking. It's as per the RBI direction, RBI guidelines. But part A is what should you just be knowing about what is this part A? Because in the examination, they do ask part A as well. No? Part B is for whom? For banks and for public financial institution. Please have a look to part A. Part A says, part A applies to securities held as stock in trade by SSE other than those covered by part B. Which is for then who is left in part A? Banks are out, financial institutions are out. Then for whom securities are held as stock in trade? Like there are a lot of dealers in shares, isn't it? Dealers in shares. For dealers in shares, for them, it is what? It is securities held as stock in trade. Now, therefore, for all these dealers, probably who are dealers in shares, for them, part A will be applicable in this context. Now, students, over here, if you see, securities are initially recognized at cost. Obviously, initially means when you purchase, it has to be at cost. Now, cost will include what? Include all purchase price plus what? All the expenditures. Can you see that? Cost will include not only the purchase price, but what? But all the students, all the brokerage fees and taxes, everything would be included in that context of the purchase price. So this is what the purchase price would be all about. Okay, that is what would be your cost. Initial recognition in the books. It will go in the balance sheet any case. Now, subsequently, what do you mean by subsequent? That is 31st of March. You will now do the measurement. Subsequent measurement will be done on 31st of March, year end. It is at cost or NRV, whichever is lower. This is very important, students. Now, you say, what is important? We already know. It is has to be like that. Securities held as a stock in trade, cost or NRV, whichever is lower. What's the big deal? But the next sentence is the big deal. This comparison is made category wise, meaning thereby block wise. And then, students, there are 4 blocks. And for each block, you take aggregate. of cost and aggregate of NRV for each block. There are 4 blocks in all. For each block, you will take aggregate of cost and aggregate of NRV. You will compare, and then it will be lower of the two. You will compare and it will be lower of the two, and that exactly how the things would be. I hope that every one of you are clear with this one. Every one of you. And that exactly is the point, students. So therefore, if you see over here, shares, debt securities, convertible securities, and any other securities. These are the 4 categories. Now, please be careful. Huh? Here, shares, if you see in this context, shares will include both, students. Equity and preference can both be included. Yes, why not? In this context. So both can be there. So you have, supposing you have got 2 shares of Reliance equity, 2 shares of Infosys preference. You will have 4 in the first category. And what do you do? The cost of all the 4 together and take the aggregate of all the 4 NRVs together. Then the aggregate cost of 4, compare this with aggregate NRV, whichever is lower will qualify on the outer side. Similarly, you have to do for the debt securities. Similarly, you have to do for the convertible securities, and similarly for you have to do this one. So what will go out, friends? What will go out? Can you see this one? What will go out is the aggregate of each category. The lower of the aggregate of each category. Aggregate of what? Cost. Compare it with NRV. Lower of the two of each category will go in the outer listing. So what qualifies in this case is 42. 42 is the aggregate cost, aggregate NRV, lower is 42. Not individual, security wise also. So here we have given security wise. We will not think security wise, aggregate, block wise. Same is here 75. Here aggregate of cost and aggregate of this thing is what? 19.8, and therefore this is how the valuation is taken. Is that clear to all of you? Every one of it. So this particular ICDS is all about how do you do the valuation of securities held as stock in trade. Part A. Part B, we don't care. RBI. I hope that every one of you are clear with this one. All of you. Is that clear, students? No doubt on this one. Now, since we are talking about, students, since we are talking about, think of it, this is how you do the interlinking. This is how you make your final CA primary in this one. I told you, you hit one concept, parallelly, whichever are the incidental concept, sweep them so that the syllables, you'll find it shrinks now. The syllables is shrinking, students. Are you realizing it? If you can sweep incidental area while you do this, it will reduce it. But if you do ICDS separately, it looks gigantic. You will be intimidated. You will be feared. There's so much to cover. It's not about so much to cover. It's all about the timing, where to cover and when to cover. Where and when is the game, students? Did you realize this one, students? All of you. If that is the case, I'm just going to put a feeder in your mind, but this we will discuss in the last lecture of PGAP, which is on Saturday. At that point of time, I'll discuss with you this particular part. And what is that, students? Be careful. Be careful, students, on this particular thing. Over here, students, if you see very carefully, there could be a case of what security do you did the valuation. From the security, you are earning interest. From the security, you are earning dividend. Question that arises, in which tax year that we should recognize the interest from securities? I'm not talking about interest on sticky loans. Interest on loans and all are dealt as per the respective discussion that we already had. Here we are talking about interest on securities in or dividend. Which would be the tax year for recognizing this income? That discussion, students, can you see this? The note I have already given. That discussion, students, you will have it in revenue recognition, ICDS number 4. Today we are not discussing it, but I'm just putting this feeder. This ICDS, therefore, was about valuation. From this security, which you have valued, you will definitely earn income. Income in the form of interest, income in the form of dividend. That income, which tax year it will be recognized? That is ICDS 4, revenue recognition. Is that point clear to all of you, students? Yes. Now, students, there is ICDS 2, which is on inventory, valuation of inventory, students. Now, students, I have made this self-explanatory for all of you. Congratulations. You would know about this. This I am giving you as a homework because I have made this as a self-explanatory to you. Do you know how? By making a comparison of what you learned in ICDS 8 and what is there in ICDS number 2. This is your homework, students. Do ensure to go through it once, and therefore you will find it easy in this case. So this is one of the best thing that you will realize it in terms of the ICDS number 2 primary. You just primarily ensure, just go through it once, students, over here, and that should be all in this context. Students, now then, this is your homework. Now you are capable of it because there are two ICDS on valuation. There are two ICDS students on valuation. ICDS number 8 and ICDS number 2. ICDS number 8 is valuation of security. ICDS number 2 is valuation of inventory. You will say, sir, many of the students will say, sir, valuation of security, just now you told us if it is held as stock in trade, means if it is held as inventory, security held as stock in trade or security held as inventory, ICDS 8. Now you're talking about ICDS 2, which is talking about the valuation of inventories. So what about a security which is held as inventory? Whether it will be ICDS 8 or ICDS 2, it has to be ICDS 8. So don't you think that ICDS 2 will exclude the applicability of ICDS 2 will exclude the applicability of what? Valuation of security held as stock and trade. In that context, that exactly is the point. See, this is how it is. So that's how the things moves in. I hope that every one of you are clear with this one. So therefore, students, now with that, the next section, then we will take a break, and then thereafter, students, this is a very small thing, students. If you see, students, if you can recall, mutual concern we discussed in, I think, the first class towards the end. That was the first class, or maybe second class. I think second class towards the end, PGBP. The charging section that we were discussing, I think second class towards the end. So if you see in that particular session, students, in that particular session that we are discussing about the taxation of mutual concern, what we all discussed, students, we all discussed in that particular session, students, that in a mutual concern, whatever is the contribution that is received from the members towards the common benefit of the members. So mutual concern, I told you, I am contributing, like say, a membership fees of say rupees 10,000 every year. Now that 10,000 is spent for the mutual benefit of the members. After spending the amount, there is some surplus left out. There is some surplus left out. Then whether that some surplus which is left out, will that be considered as income? I told you no. I gave you the example of picnic. Remember that? I gave you the example of picnic. What was that? After picnic, you all contributed. You went for picnic. After picnic, after the expenditure done, there was some contribution that was left. Whether that contribution that was left after spending in the picnic, whether that amount is an income? No. Why? Why, students? Now be careful. Why it is not an income, students? Why it is not an income, students? The reason is my voice is not audible because it was my income only. Because it was my income only. Isn't it? Students, be careful. I am now giving you a statement. I want all of you to write it down. Please write down the statement. A statement. All of you will write down. So Kanaya said, because it was your money only. Perfect. Please write one sentence, students, all of you. If 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 the identity if the identity of if the identity of the contributor, if the identity of the contributor and and the participant of the surplus and the participant of the surplus is the same is the same, then the surplus is not an income. Do you all agree, students? Do you all agree? Then the surplus is not income. I gave you the picnic example. You all contribute 1000 rupees. 10 people go for picnic. So 10 people means how much total contribution? 10,000. After that, total expenditure in the picnic was 8,000 rupees. How much is left out? 2,000 rupees. What will happen in this case? That 2,000 will go to the contributor only. So the identity of the contributor and the participant of the surplus is the same. And therefore what? The surplus, which in my example is 2,000, is not an income. Do you all agree to this or not? Quickly, students. All of you agree or not? Perfect. Now, students, if you tell me in that context, agree. Yes, one. Agree. Perfect. Perfect, students. If you all agree to this effect, so let me, in fact, I told you also, students, but if supposingly one particular person, like I gave you the example of stock exchange on the other day, that one person wanted a special service from the association. For that, he paid the fees. Now, obviously, stock exchange is providing a special service only to that particular person for which he gave the fees. So this is like a professional service given by the stock exchange to that person. Now, if at all there is a profit that will be earned by the stock exchange to provide the service to that stockbroker, whether the profit will be returned? Answer is no, which means that the identity of the contributor, students, the identity of the contributor is the stockbroker. Surplus participant is not that stockbroker who contributed. It may be distributed among everyone. Those who have not even contributed, they may be the beneficiary. Do you all agree to this one, Radha? One point I just want to think of it, students. In a company, students, in a company, who is contributing the amount? Contributor are the customers. So identity, the one who is contributing is the customers. And the profit goes to whom? To the customers or to the shareholders? Whether the profit goes to the customers or to the shareholders, that profit goes to the shareholders. That profit goes to the shareholder. So can we say then the profit is the income? Answer is yes. Theory of Oil Western Bank, very old judgment of the Supreme Courts were there on this. Audible? Full judgment. I hope that it is now audible. Example, shareholder were the contributor for the surplus. Then whatever was the profit went, customers were the contributor of the amount. Then we got the profit. The profit goes to the customer back or to the shareholder? Shareholder. So identity of the contributor and the participant of the surplus are not the same, and hence that profit is an income. Hence the profit is an income, students. I hope that all of you are clear with this one. If that be so, let's then begin with this last section and then immediately we'll take a break. And after the break, students, depreciation. Students, please have a look. Please have a look. Part B, rather, of ICDS, I told you, Part B is applicable for, Part B of ICDS is applicable for banking company and financial institution. Isn't it? Part B of the ICDS 8, applicable for banking company and financial institution. What did I told you? You don't have to worry about it because that valuation would be based on the RBI directives. So RBI directives from time to time, whatever it is, on that basis, the bank and the financial institution will do the valuation. We don't have to worry about it, isn't it? So even that need not be done. So come back, students, in this case. Students, please come back. In this context. So if you see, students, over here, please have a look. So just have a look, students, over here. There is a association. So every association has got two sides. Every association, students, has got two sides. One is the when there's a mutuality. Mutuality, students. And when the mutual concern is providing a specific service. I told you that the specific service, students, the specific service, this is where there is an income. In the case of mutuality, this is not an income. Let's take a number, students. Numbers is like gross receipts, like membership fees, isn't it? Say gross receipt is 100. Now less the expenditure, common expenses for the member, say 80. So therefore 20 surplus. What we say? Surplus is not an income. Surplus is not an income. Do you all agree to this one? Yes. Now sometimes what may happen, students, sometimes what may happen, if surplus, which is a positive amount, if surplus is not an income, what about the case where supposedly my expenses this year was 120? So in that case, I have got what? Deficiency. This is known as deficiency or negative income. Okay. So deficiency is also not my income. Means not an income means it is not accessible. Neither surplus is accessible because it is not an income. Similarly, even deficiency is not accessible because this is not even an expense of that nature which is accessible. So the neither surplus, this side is not accessible. That we all know. Now, what about the specific service, students? For specific service, we know, students, say for example, that fees charge. Say fees charge, students, is say 50. Fees charge is say 50. Now, in that case, say expenses for that, there will be some expenses, say rupees 20, say rupees 10 for providing this expenses to provide specific service. Expense to provide the service, students, this is say 10. That is then will get you what? 40. Do you all agree to this one? Now, students, be very, very careful on this particular part. Now, on this particular 40, students, the question is herein, can you now surplus is not an income because it is not accessible. Same I told you also about deficiency. It is also not accessible. So if it is not accessible, where is the question of any deduction? There is no question of deduction. Do you all agree to this one? There is no question of deduction. But is there an exception to this rule? Answer is yes. This is the exception. So exception means what? If it is not accessible, there is no question of any deduction. If because even surplus is not accessible, so the surplus not being an income, where is the question of its taxability? Similarly, deficiency is also not accessible. So therefore, where is the question of its deduction? But income tax law under section 44, provides deduction of deficiency. Now, how much is the deduction of deficiency, students? Be careful, it is 50% of the total income. 50% of the total. Just students, just hold on students here. I'll just make a bit of correction. I'll make it 20 students. Here I'll just make it 20. Okay, expenses of this, and therefore this I have made it 30. Now just have a look over here, if you may. So what I get it over here in this case, 50% of the total income will then be compared with what? The actual deficiency amount will then be compared with actual deficiency amount. Now actual deficiency is 20. 50% of total income will become 15. So lower of the two is 15 that will be allowed as deduction, and then the total income in this case will be how much? The total income in this case is 15 is the final total income amount. I hope that all of you are clear with this one. Now, one may say, sir, then what will happen about the balance deficiency? Will it be allowed to be carried forward? Now, students, you are getting ambitious. Balance deficiency of rupees 5. Whether this balance deficiency of rupees 5, will this be allowed to be carried forward in the subsequent year? Answer is no. This is not like your normal business loss or an assessable loss that is allowed to be carried forward in a normal way for 8 years. This is your exceptional case that we provide you a deduction because we don't want to tax. See, understand the intention of legislature. They don't want to tax these associations. So therefore, if they have got loss, just a bit of pity that they do, and they have given them the deduction. Mercy, you can say. They have just done a mercy. So this deduction is based on mercy. That is the theme that you can say. Deduction based on mercy in the income tax law for this section. I hope that all of you are clear with this one. Mercy deduction, this is deduction. Otherwise, there is no concept of deduction of these deficiency, which is in the non-assessable side. And then once you get the deduction, and if the deficiency is not fully adjusted, then you become ambitious. You say, sir, why not to carry forward in the subsequent tax years? Will not be allowed. Once getting deduction itself was a big thing. Is that point clear to all of you students? Now students, this particular part, students, this is very simple thing. And the important thing, students, I've already covered it, like preliminary. Remember this VRS? Last lecture, students, VRS. Remember expenditure on VRS? This is the list I have given you about amortization of expenditure. Simple one. A list, students, I have given you about amortization of expenditure, but still I will try to do this particular list, students, a bit later. But if whenever you have got time, do just particular read out 1 page only. It is there. List of all the sections which is about amortization. And the best part, for your examination day, students, for your examination day, I've also made the summary over here. This is summary that you will revise it primarily on the day of the examination. Okay, I'll do it. Don't worry. This particular part towards the end of PGVP, I'll just try to do it. Hardly it will take me 10-15 minutes, but I don't want to dilute my session on depreciation now. So students, take a break quickly. I think 8:05. So 8:15 we will meet up for depreciation. See you then. Yes, yes. Yeah, break. 10 minutes. Okay. So students, welcome back. Now students, as you know, yeah, संकेत start करते हैं. हाँ अभी बताइएगा. अभी ठीक है. अभी ठीक आ रही है. Perfect. So now students, let's start. Students, as you can see over here, depreciation. Now this is again a, I can say, in the common provision of deduction. We have seen the list of the common provision in the master chart, which was given to you in the first class only. In the portal, it is there. In the portal, students, it is there. So those who register through portal, please see all the PDF available, the class notes available. So the biggest deduction, the biggest section in the common deduction is the depreciation. The common, talking about it. Section 33 is the depreciation provision in the new Income Tax Act 2025. Earlier, old one, 32. New it is 33. Students, however, you will say that you will realize, students, in this case, that more or less all the things that we have learned in your inter CA, those are tallying actually. More or less, I will say. So therefore, in that situation, students, this will not be the case. Now, this module, which is going with this particular class notes on depreciation, which is on 4th of August, this covers these 4 parts, A, B, C, and D. The basis of depreciation. This is what it is. Part B, eligible assets and the rates. What are the eligible asset, tangible, intangible, and what are the rates of depreciation in that context? Thereafter, in the rate, whether we have that, remember that 50% rate of depreciation, whether that 50% of the normal rate, is it available or not in the new law? That 50% rate, remember that if you use the asset for less than 180 days, then you will be getting 50% in the current year. That is what it is. Whether you remember there was additional depreciation that you have learned, whether that additional depreciation concept survives in the new Income Tax Act 2025. This is also the case covered in Part B. Part C is about the condition for depreciation. Students, if you remember, the condition was of the ownership of the asset and the asset should be put to use. Ownership of the asset and the asset should be put to use, the user test and the ownership test. So that is Part C. And there are certain special points like hire purchase. In the case of hire purchase, whether the hire purchaser, can he be considered to be the owner and accordingly be eligible for depreciation? That is how it is. In the case of leasehold, primarily whether the lessee or the lessor, who will be eligible to claim the depreciation? That is what is discussed in Part C. And then finally, part number D, unabsorbed depreciation and the hierarchy of set-off, which I got opportunity to discuss with you before the break itself. That is what it covers, the scheme of depreciation so far as section 33 is concerned. Is that point clear to all of you? This is what it is, and this is how you should revise it, students, also. This is how primary students, you should always revise it in this context as well. Is that clear, students? Now, if that is the case, students, let's look upon to this. I think these provisions, the best part is that you're familiar with it. Students, if you remember, now, as you can see the presentation, students, module page number are always given in the notes. You will find that the module page number has been covered so that whenever you want to just cross-refer it, you can definitely do that. Now, students, over here, students, remember, there was straight line basis of claiming the depreciation. There was a straight line basis of claiming the depreciation, SLM. And then there was a block method. One was a straight line basis, another was the block method. All of you are aware of this one or not? And if you can recall, the straight line basis, students, was for the undertaking which was engaged in generation or distribution of power. Please be careful. This particular option of this, I'm telling you, students, one thing. Prior to 1988, this was only the straight line method only that was applicable because there were many assets. Then there was some big amendments that took place during those 80s era because then we found that the industrialization began in our country. Many assets primarily were being used. So now to keep a track of each and every assets became very difficult. So therefore, because of this industrialization policy, we in fact also moved in our income tax law from a single asset depreciation to the concept of block. So therefore, we have now the concept of block on the basis of which you get the depreciation. But the single asset depreciation or the straight line, may I say the perfect word used, not single asset, the straight line method of depreciation is given as an option that continues, that method continues, but as an option. And that option is to the power generating unit. Let they decide if they also want to switch over to the block or they want to continue with the straight line. That is the limited particular point that you should know about it. Nothing more needs to be known. So far as this is concerned, the block is the ultimate scheme that you should always bear it in mind. But at least you need to have an idea that yes, in the current Income Tax Act 1925, the new Income Tax Act 2025, the base of depreciation, we we have the optional scheme of straight line method being extended to only to the power generating units, power generating undertaking. I hope that all of you are clear with this. For all the other SSC, for all the other SSC students, do they have the choice? For all the other SSC, do they have the choice? Answer is no, they don't have the choice. They have only one particular method, which is that, students, the block method. Now, students, if you talk about the block method, what is block of asset then? Then we come to this one, students. What is the block asset? The same particular thing, so you are aware of it. Block asset, see the definition, students, here. Module, as I told you, the module references has been provided to you. A block of asset means a group of assets falling within a class of assets comprising of tangible assets, building, machinery, plant and furniture. So intangible asset, students, there is four block. That that is the larger category. Within that category also, students, there could be some subcategory because there is one more condition, same percentage of depreciation is prescribed. So if supposedly building, if there are two rates, 5% rate and then there is a 10% rate, there are two rates of depreciation. So how many blocks can be created for the class of asset being building? Two blocks can be created. Similarly, for machinery, primarily, if there are more than like 15%, 60%, 40%, so on and so forth. So n number of rates, n number of block in the same class of asset, which is same machinery. And that is how the things has to be considered. So this is how you prepare the block. I think that is something that you are aware of it. That rate should be the same of that class. And if there are rates, there are multiple rates of the same class, then that much number of blocks of the same class will get created. This is what is the concept of block of asset. So what is the slogan? See this one to remember it, students, to remember it. Same class of asset plus same rate of depreciation. This is a slogan that you have to remember. And the example which I just gave it to you, that has been covered. Is that point clear to all of you, students? Every one of you? Now, students, if you see the format of the block in this context, the statutory format of the block, let's have a look to the format. Section 41, students, please have a look. Written down value of the block. The WDV, students, be careful. The WDV. Now, this is where the things goes into picture. There is an opening WDV, students. Students, there is an opening WDV, point number A in this context, or WDV of the block of asset in the immediately preceding the tax year. If supposingly, let's go to the last year, just take the last year, students, because the last year was this one. So A and D, just take across the last year. WDV of the block of asset in the immediately preceding tax year in this context. Then less the depreciation actually allowed in respect of that block of asset in relation to the said immediately preceding tax year, means the last year. So whatever was the opening WDV minus the depreciation which is actually allowed in this context. All of you agree to this one, students? Every one of you? Fine. Then what you get, students, is that opening balance in the current tax year. Because now this presentation, you'll say, why this? Because see, we know that this law has become effective from 1st April 2026. But they just want to show there is a continuity from the old. So we should not feel that this is as if that new block is created, new action cost. No. So this presentation is just to highlight the continuum that has taken place from the old law. Obviously, that earlier one would be as per the old law. So now we have the opening balance as on the 1st of April of the current tax year. Add to that, students. Now what happens if supposedly you acquire any asset, actual cost of any asset falling within that block. So if you acquire it during the year, actual cost as determined under section 39. So actual cost under this, the new act is under section 39. So whatever is acquired and put to use during the tax year 26-27, that will be added to the block. Then less, students, can you see the word money payable together with scrap value, if any, in respect of asset falling within the block, which is sold, transferred, demolished, destroyed, or discarded during the tax year. Such amount cannot exceed this, obviously, money payable. Money payable, meaning thereby I am selling the asset and I have to pay the money. Is that the case? I am selling the asset and I have to pay the money. Is that the case? No, money payable means from the person who is payer. From their perspective that the language is written. So how much money he has paid for the asset. Now asset, even though it may have been scrapped and for which you have received the money, then that will be reduced from the block. So it is not only about money that you have received on this sale that would be reduced, even though the money which is received to you on account of scrap, on account of the asset being demolished or destroyed or discarded for whatever be the reasons. And if for that you are receiving the money, that money so received would be reduced. Is that point clear to all of you? Slump sale point number E for the timing, students, just keep that in your side. Once the money which you have received, which from the other party's point of view, it is money that he has paid to me for the asset which is sold, for the asset which is scrapped. The money can also be in the form of an insurance money because it may have been destroyed because of some calamity and the asset was insured and therefore I received the money, insurance receipt. So even that will reduce my block to that extent. And finally, then students, I get what? I get the WDV. Can you see this WDV at the end of the year on which depreciation is allowable? Less from this, students, depreciation for the current tax year. And that will be as per the rate prescribed under the income tax rule. Now, earlier, old income tax rule 1962, it was rule number 5. It is now rule 25. And the additional depreciation is governed by the section which is 33 subsection 8. After reducing the depreciation for the current tax year, you get the opening WDV for the next year. I hope this format is very clear to all of you. I think that many of you are also aware of this format, isn't it? Now, students, the caution that has to be considered over here in this regard. 3 cautions I have given it to you. I already have discussed, students, over here In this case, for the time being, I will just know that depreciation actually allowed is what is reduced from this particular part. This discussion, students, I will have it in the next class, this particular point number one. I'll elaborate more on that. Right now, I'll just keep it a bit secret. The next session, I will unfold the mystery of this. Point number two, the reduction of money payable primary and not of WDV or of the cost. Please only reduce what you receive. Don't reduce the proportionate WDV of the asset which has been sold. So whatever you receive primary is what you are supposed to reduce. That is what this point number two is. And the reduction is capped. Obviously, if the money which you have received, your block, students, your block cannot be negative. You'll say, sir, when the block will be negative? The block will, you cannot say the block will be negative, but some students who think that, sir, say for example, the money that I've received is say rupees 100. My opening WDV and the addition is say 80. So the money received is more as compared to opening WDV and the addition. So in that case, which is 80. So in that case, the surplus, which is 20, that 20 would be referred as what? Short-term capital gains, and your block value would be nil. Is the asset still in block? You may say, yes, sir, some assets are still there, but now the block value is nil. Why? Because your selling price, say is 100, has surpassed your WDVs. What is your WDVs? Opening and the actual cost of any new asset. Opening and the actual cost of any new asset, say combined together it is 80, and one asset I have sold, and that one asset which I have sold, I have got the amount of rupees 100. Then in that particular case, I will not say my block value now is minus 20. Incorrect. Your block value is nil, and that surplus, which is of 20, is your short-term capital gains. Is this point clear to all of you up till now, students? Then we shall proceed further. All of you confirm up till here. Everyone? Confirm? Yeah. Towards the end, rather. Towards the end, we can ask. Okay? Everyone, students? Perfect. Let's proceed further now. Students, let's proceed further, students. This point number one, which is a mystery I'm going to unfold in the next class. I'm just keeping the suspense on this right now. So, see this particular part shows number of asset in the block, a working column, not a statutory one. Can you see that? Section 41 speaks only in terms of amount, like the WDV format, what we discussed. The count of the asset in a block is not a statutory requirement, but it is worth maintaining as a working column in the class chart. In that case, for that class of the asset for which you have prepared the block, because it is the count, because students, because it is the count, not the value. It is the count, not the value, that answers the question decided in Yamaha Motors Delhi High Court. We will see, students, where the question that is to be asked is the block ceased to exist. How do we know that the block has ceased to exist? Because the value of the block is zero. Can we say that the block has ceased to exist? Is the question to be answered. These are very fundamental things, students. Just because the value of my block has become nil, how the value of the block has become nil? I gave you the example also. 100 rupees, I received the money for that one asset, which was much higher as compared to my opening WDVs as well as the actual cost for the new additions. So whether I say that the block has ceased to exist, answer is no. block value is nil, but it doesn't cease to exist. There are assets still in the block. It doesn't cease to exist. I hope that all of you can appreciate this particular final point. Okay. So that is what it is in this case, in this particular context. Okay. Now, students, come to this particular part. Just have a look to this one, the chart again. If I just forget now the opening, that continuation and all, just focus only on this part. Just focus only on this part. This is your thing that needs to be focused. So number of asset in the block, I'm just creating for it. We just need to know only for the purpose whether the block has ceased to exist. So this is not a statutory one, but still I keep it just to know whether the block has ceased to exist or not. Okay, just because the value no longer exists. Why value no longer exists? I gave you the example 100 minus 80. You have a short term capital gain case. The block value is nil. Just because the block value is nil, it doesn't cease to exist. Okay. Now, students, just see over here the depreciation part, less depreciation, normal depreciation, and additional depreciation. Normal depreciation, students, whatever is the rate that you will pick it up, rule 25, and 50% of the rate for the asset acquired and put to use for less than 180 days. 50% of the normal rate if it is acquired and put to use for less than 180 days. Additional depreciation also you will see, that is 33.8. Open WD for the next year. Now comes, students, this particular part, which is, see, all the case law, students, whatever the things are covered in the module has been referred over here. Let's read the facts over here. The entire block of plant and machinery chargeable to depreciation at 15% contained 20 machinery items. One machine used for packing became obsolete and was discarded during the year. It was not sold, nor it was scrapped, not disposed of, but discarded means obsolete. So there are some assets as obsolete, just discarded. I'm no longer going to be used now in the operations. It is no longer going to be. See, in the big factory, some assets, you see some plant and machinery are just kept. He wanted to sell also, but nobody is a taker. Anyways, he said that, okay, fine. This plant and machinery is now retired, primarily, and nobody is a taker, so just leave it somewhere in the corner. It is discarded. I'm not getting any money off that. The question, therefore, students, to all of you is that, in this case, the assessee claimed a depreciation which was also attributable to that asset. The assessee claimed the depreciation which was also attributable to that asset. The assessing officer disallowed that. Why? That asset is not put to use in this case. And because it is not put to use, therefore, where is the question of allowing the depreciation in respect of that asset in this case? Because put to use was the condition, you remember that, apart along with ownership. Put to use was also the condition, and therefore the assessing officer in this case has disallowed it. Now, this was a landmark judgment of Delhi High Court in Yamaha Motors. What was that? It says that this single asset is discarded. This single asset is forming a part of the block. There are other assets which are also the part of the block. Okay. Now, the single asset use test, be careful what I'm saying. The single asset use test is relevant only in the case of a newly acquired asset. A single asset use test is relevant only in respect of a newly acquired asset. Why? Because a newly acquired asset will be eligible for depreciation only when it will be forming the part of the block. Unless that new asset enters into the block, it will not be coming to the claim of depreciation in the format that we just saw. So the newly acquired asset, the newly acquired asset that is there over here. In this case, the actual asset that you can see in this context. So the newly asset acquired during the year. Can you see this one? So this will be eligible for depreciation only when it will be a part of the block. And when it will be a part of the block, it will be a part of the block when this newly acquired asset has been put to use. Once the newly acquired asset is a part of the block, how it became a part of the block? Because it was put to use. Then thereafter, students, be careful. Then thereafter, students, we are not supposed to apply the single asset use test. Why? Because that single asset use test is required only to ensure that whether the asset will be a part of the block, because unless you be a part of the block, you will not be eligible for depreciation. And once the asset is a part of the block, then that single asset use test does not survive. What is to be seen now is whether the block as a whole, if that is in use, whether the block as a whole, if that is in use. So if the block as a whole is in use and few of the asset in that particular block is no longer in use, and for that asset you have also not received any money, again I'm repeating, if the block as a whole, if that is in use and few asset in that block is no longer in use, but for those assets you have not received the money, please tell me whether those assets will continue to be a part of the block. Please tell me whether those assets will they continue to be the part of the block. Answer is yes. Those few assets, because you have not received the money, the asset will continue to, because the format, this is not my format, this is a statutory format. The format, what does it says? It says that the asset will be thrown out of the block only when you receive the money. You receive the money. That money can be a scrap money, a sales money, or an insurance money, but you need to receive the money. Only then the asset will be out of the block. But if you have not received the money, the asset continues to be a part of your block. It continues to be the part of your WDV. And then the single asset use test no longer is applicable for the block as a whole. It is the block as a whole which should be in use. And if the block as a whole, if it is in use, you claim depreciation of what? Of the WDV of a single asset or the WDV of the block. You claim the depreciation of the WDV of the block. And hence we say the asset which is just one asset, two asset, three asset, which is discarded, no longer in use, but for which you have not received the money, does that asset still survive in the block? Yes. And then, even though it is not in use, the block as a whole that is in use. So whether the that few asset which is discarded, whether they be eligible to claim the depreciation, and the answer is yes. Please take a note of it. I'll just dictate to them this landmark principle of Yamaha Motors once. Yamaha Motors Private Limited. Quickly, students. Whether whether few asset whether few asset which is discarded, whether few assets which are discarded, but for which but for which no money but for which no money was received but for which no money was received, be eligible for depreciation. be eligible for depreciation? Question mark. Please write. The single asset use test, the single asset use test is applicable, is applicable only in respect of, only in respect of a newly acquired asset. That is, that is, that is, in the case of a newly acquired asset, in the case of a newly acquired asset, it will be eligible. It will be eligible only if, only if it forms part of, it forms part of the block. It forms part of the block. And such asset, and such asset will form part of the block, will form part of the block only when it is put to use. Only when it is put to use. Full stop. Next line, right, students? Once the asset forms part of the block, once the asset forms part of the block, then subsequently, please underline the word subsequently. Then subsequently, it is the block as a whole, it is the block as a whole that should be in use. Underline the word the block as a whole. That should be in use. And hence, if some of the assets in the block, and hence, if some of the assets in the block is not in use, and for which the SSE has not received, and for which the SSE has not received any money whatsoever, then the asset continues to be a part of the block Then the asset continues to be a part of the block as per the statutory block format. As per the statutory block format, and hence the SSE shall be eligible for the SSE shall be eligible for the depreciation. The SSE shall be eligible for the depreciation on the WDV value of the block which includes the discarded asset which includes the discarded asset. The students, I have seen certain questions in the examination when you find it. Very old attempts paper. Some attempts I can see a total income question students was targeted, where this is what was the information given. Say for example, total you were required to calculate the total income of a company, and they tell you that the net profit of say B Limited is say rupees say 100 lakhs. Net profit of B Limited is 100 lakhs after debit and credit of the following. After debit and credit of the following. Now see in the examination students how ICAI targets the concepts in the examination. You should know how to apply. Now you have understood the concepts. But even after understanding the concepts, still we miss out on the application part. So it is very important to also primarily practice more past attempts, particular RTPs and all, which I think ICAI would be releasing their materials now. And I'm telling you, there are world-class primary content in terms of the questions which the ICR releases in terms of in the MTPs, RTPs. It's a really a ultimate particular case studies and all. So please ensure to go through those things so that you will also be in a position to appreciate small nuances from those MTPs and RTPs or those question banks whenever the ICR will release later on. Please ensure to get your hands on that particular materials. Now, students, if you see net profit of B Limited, rupees 100 lakhs after debit or credit of the following. Now, what is that following? Like, say, for example, like depreciation as per the books is, they will tell you, na, depreciation as per the books is this much. What you'll do, you'll add back. Say, one of the adjustments says, one of the debit, rupees 5 lakhs debited, being loss of plant and machinery by fire. Okay. No insurance compensation was received. No insurance compensation was received by the company. So, and accordingly, they will give you some more adjustments like depreciation as per the book, so on and so forth. TDS not deducted, one adjustment of that. Amount paid after the due date of filing of the return of income, all those adjustments would be there. Apart from that, this is one of the adjustment, and then they will tell you, then they will also give you other heads of income, then additional information. In additional information, they will tell you something about chapter 8, which was earlier chapter 6A, and then the total income. They will ask you compute the total income, or they will in additional information they will give you something about brought forward losses. Now visualize. You should try to visualize now. That is how you will try to build up. So don't read anything in isolation. At the very start only, don't wait for that. No, let me cover up the entire thing, then I will start this. No, at the start itself, start visualizing the impact. That will help you to be at ease as and when those taxation of various entities topic will come. Because in taxation of various entities topic, you will find all the total income kind of a questions that is there in those taxation of various entities. Now, in that context, Shruti, if you see in this regard, please have a look over here, Shruti. Now you have to compute total income. Now, if you see outrightly, this debit is wrong debit. Why? Because this debit, if you see, it is a capital loss. It is neither. Is it a trading loss? And the answer is no. Loss of plant and machinery by fire. Is it a trading loss? Answer is no. In this case, is it a loss in the normal course of business? Can we say it is a proper debit as per the commercial accounting principle? Answer is no. There is no question of this. So this loss has to be added back. So what probably when I do my PGBP, in fact when I do my PGP, I say net profit as per books, which is 100 lakhs. All of you agree? Then I add this capital loss. And this is where 99% students, they stop it over here and they move on to the other end. No. When when the question further says that no insurance compensation money is received, do you know what they're trying to give you an impression? Because no money has been received, this asset should continue to be a part of the block. And if this asset should continue to be a part of the block, please have a look to the depreciation adjustment. They will tell you depreciation under income tax law without considering this adjustment number one. Some hint they will give you without considering this adjustment number one. And therefore, you should now understand that this has some proportional depreciation I should give. So therefore, you have to write less what? Less proportionate depreciation. Say at the rate of 15%. How much is that? 75,000. This you will remove it and then other adjustments and then PGAP. Many students again will say, sir, but in this case, the asset is no longer in use. And the asset doesn't exist. Who cares? What I told you, the moment asset enters into the block, when it is put to use, then the identity of the asset is, the individual asset identity is lost. It is the block as a whole that survives. It is the WDV value of the block which is eligible for depreciation. That single asset will be removed only when you get some money out of it. Therefore, we get a reduction in the block on account of the money which is payable. Only then it is reduced, or else it remains a part of the block. And hence, if such adjustments are being given to you, then you will have to say add back capital loss. Please don't forget to give the proportionate depreciation. I hope that this concept is well taken, because students, this is one of the concept. See, other concept like small. Now, can you see this one? These things are like more like an inter-CA thing, which has been there, which you are expected to know. But any case, these are something that you can easily go through, like all the how to calculate depreciation, the block, add additions and all. Put numbers and you can calculate it. Any case, I have given it because I have to give you as a homework, so that at least you know that the calculation is the same that we used to do always. Okay, those things primarily just to know that, okay, just as a confirmation that nothing has changed. Whatever you calculated it earlier, same calculation is there. This is just like a confirmation. But this is where, students, you need to be very careful. This is how the questions are being targeted. I hope that all of you are clear with this one, students. Every one of you. So students, can you also then take some more homework? Just I'm giving you inter-CA part apart from today, which I gave you one particular part, which was ICDS 2. Other than that, just today's students assignment part in this case. So here, students, we have already have covered. Can you see this one? Herein, we have already covered what is block of asset, this entire statutory format. This has been covered. Now, in this case, three caution. The next class I will tell you about one caution. Other already have covered it in this case. Apart from that, students, just as an assignment, now the chart, this particular part is covered. Discarded asset which remains in the block, this has been covered. The put to use test, this is what I have explained to you just now. Single asset use test is something considered only for the newly acquired asset. Subsequently, it is a block as a whole that should be in use, and that exactly is the point. Now, friends, illustration. I just want you that just go through this illustration primarily, because these illustrations are something that just a confirmation that you are not doing anything new. Whatever you did in the old Income Tax Act, vis-a-vis rules. Same thing applies over here also. This is one thing just I just want all of you to go through it. Illustration number 1, page number 11. In this case, notes are being given in this context. That should be all. And one more thing, students, if it is possible, I think that should be all. Rest of it we can just do. Eligible assets centered. Illustration 1. Just take illustration 1 as a homework. Rest of it we will just capture it. Don't worry, in the next class. Fine, students. So illustration 1 and ICDS 2. That will be an assignment for today. Then thereafter, students, we will be discussing it in the just a second. Just hold on. Perfect, Ruth. Now, Ruth, any doubts that you have, please let me know. Page number 11, illustration number 1. That is it. Any doubt, students? Kanaya, I will ensure I will push it to get this today's notes uploaded maximum tomorrow. First half, I'll try for the tomorrow first half because that uh, that I think that has been done anyways, so that should not be an issue. Okay. I hope that all of you understood this Yamaha Motors case. Everyone just confirm on that part just quickly. Radha, Kanaya, Muskan, Abhijit, all of you just confirm once. Sir, my query was you took suddenly the mutual consent topic suddenly in the first profession. Like with what correlation is it? The correlation rather was percentage as a total income. If you see the deficiency deduction that we are getting is 50% of the total income. So the deduction is again 50 is a percentage of total income. Same is also with the provision for bad and doubtful debts for the banking company. 8.5% of the GTI, which is nothing but the total income. So these are the two sections where the deduction is a percentage of the total income. That is precisely the correlation between the two. Why we have kept these two sections together in one compartment, in one bucket, that was the reason. Muskan, I just confirm Kanaya and Muskan is saying August 1 on the portal. Is it not there? Please confirm once. August 1. Which means that other students just confirm once. Kanaya and this thing, it is not there in the August 1 notes in the portal. Sir, till 30th of July. Okay, fine. Okay, students, not an issue. Kanaya, perfect. I got it. Got it. Anyways, ICDS 2 family, which has been there, and illustration 1, not heavy, you can do it later on also. It's not that you have to do it today, that there is a linking with the one, but I will just request the concerned person to put it. Okay. So, students, that's it. Any other query, students, that you have? Or else then we can. Whether my understanding is proper, confirm. Is the discarded asset is eligible for depreciation since it is part of that block? Am I right? Yes, why not? That is what it is. That is what it is. Discarded asset, if you don't receive the money, it still continue to be the part of this block. See, that format is a statutory format. And because it is a statutory format, you don't have any, your choice. One may say, that, sir, but that asset is not in use, doesn't matter. The format says that the asset will move out if the money has been paid. No money paid, that is it. It will still be a part of your WDV, and if it is a part of your WDV, if the block as a whole, if it is in use, that is it, students. Thank you, Muskan. Yeah, that is what it is. The beauty of the income tax law. So that's a beauty of this thing, and the way the interpretations are done by the court. So that's a joy of learning at the end of the day. These are the joy of learning, friends. If you apply it properly, this is really a particular catch point. So you should always have this thing, na? Apply. There has to be some purpose. The why of the provision is the game. If you can understand the why of it, everything becomes primarily will start falling in place on its own. The background, if it is known, the foreground becomes clear. This is precisely how you should always have the approach, not only for the subject, any particular thing that you do, at the subject or maybe in life. Background clear, the foreground becomes easier. The court judgment, do you need to mention? Not necessary. The court judgment primarily, they don't even now have stopped asking any particular thing that they require you to write the name of the judgment. There is no such question that is asked, but you need to formulate it properly. That what is the issue under consideration, what which is there, isn't it? Like for example, in Yamaha students, I have made an issue at the first line. That first line that you have written is the issue under consideration. And then thereafter, like what is the proposition or the principle or the provision as applicable? You need to write that very clearly and properly. And then analyze, conclude. This is how this needs to be broken in a proper structure. Issue under consideration, the principle or the provision as applicable to that particular situation. Analysis, given analysis, you need to analyze, correlate the things, and then finally the conclusion. This is a structure which is expected from you at the final level. This is what it is, and that is generally in the questions which involves the case studies primary, which would be there somewhere later on. You will find it. संकेत जी पीपीटी की जरूरत अभी नहीं है, हो गया लेक्चर आज हो गया, ठीक है. सो एनी अदर क्वेरी, जस्ट क्वेरी ले रहे हैं इसके लिए. एनी अदर पर्टिकुलर क्वेरी स्टूडेंट्स? So shall we wind up? Okay. So see you then, students, in the next class. Just in the next class, students, we will complete the actual cost and some proportionate asset, the WDV concept. This is something that we need to do. And also, students, like the 35 deduction, section 35 deduction or 35 AD is what we will try to close in the next class. Thank you, Radha. Thank you very much. Thanks for the compliment. Bye. Take care. Good night to all of you, students. Take care. Bye-bye. संकेत जी बंद कर देते हैं.
Recording stopped.
चलिए, गुड नाइट संकेत जी.